The Atlantic Stable Income Fund is in our review today, and this is a relatively young fund and established in 2009. Cobie has more details on the fund.
Yeah, absolutely. I mean, if you look at this fund, it comes to you courtesy from Atlantic Asset Management. This is a business that was created a couple of years ago, and they really specialize in what we call fixed income, which is really the bond space and the cash space. And we've got Albert with us today, who will be taking us through some of the details as far as the fund is concerned. Maybe just as a start, have a look at your screen over there. There you see some of the fund credentials coming up. Total expense ratio of about 55 basis points for this. Steffi Composite, which is in essence a cash fund at the end of the day, and 458 million is the total size there. Just looking at returns, Atlantic Stable Income, 6.27 of the last year relative to 5.7. That's the Steffi Index. And over 2 years, the 6.80 versus 6.27, handsomely beating the benchmark. You must remember in the cash space, it's fairly difficult to beat the cash curve by very large margins. This is not equities, this is cash. So you're looking for very small outperformance over and above the index over rolling periods. Just having a look at the rolling chart, if you look at your screen over there now, the blue shaded area indicates the fund's relative return to the benchmark. And you can see outperformance for this fund relative to its benchmark over time. There's no underperformance, as is often indicated in the equity space. And then if you look at the red line, you'll see the rolling 12-month return for the Steffi Index. And that you read off the right-hand side index, which is the right-hand side that you're seeing on that side over there. Albert, you're fairly critical in this fund, and you look after it on a daily basis. I mean, your objective here is Steffi. So tell us some of the internal workings. What are some of the stuff that you're looking at the moment?
This fund was created in order to compete directly with the money market fund space. A lot of the money market funds are massively large in South Africa, and a lot of the investors put almost all their money in there. Almost over 20 to 25% of South African unit trust monies is in the money market space. So it's a massively large space, and I think there's a lot of space for investors to take their money a little bit higher up the risk curve. This fund tries to attempt to do it by increasing duration. Firstly, what that means is money market funds have a maximum term of 1 year that they're allowed to give money to a company or to a bank. This fund can lend money out up until 3 years. That's the first difference. The second difference is that the difference is in credit ratings. So where money market funds have very strict limits as to what they can invest in, this fund has slightly looser limits as to what it's allowed to invest in. The fund still tries to get as far as possible money market-like performance. What I mean by that is that the fund, you'll see if you look at performance figures, generally has a very predictable month-on-month return, no negative months thus far, touch wood. And hopefully going forward will continue to perform that way.
Well, Roland, looking at the performance, it looks relatively conservative. I mean, when you look at what the returns could be if you're invested in equities.
Oh, so of course, compared to equities, it is certainly conservative. But if we're looking at Steffi as the benchmark, we've got to see how conservative it is relative to Steffi. Maybe I can ask Albert, what kind of you say you've got a looser kind of mandate there. What's your sort of exposure to higher yielding sort of corporate debt or any kind of yield enhancement strategies in there?
Well, Roland, we're all limited to a more or less degree by the regulations in the country about how much risk we're allowed to take. This fund does take more risk than the basic money market fund, and while you are correct that it is a very conservative fund compared to equities, we all have space in our portfolios for a fund like this, just as we all have space in our portfolios for equity funds. I myself in this fund have exposure to all the big 4 large banks. I have exposure to some of the smaller banks. Able Capitec, I have exposure to some of the smaller microfinancing players, whether that's Real People or RCS. I go down, I have some money with Grindrod. There's a lot of places where you can go with this type of fund. Most of the corporates, and generally we try to take the risk in the appropriate places and try not to risk the investors' money. This is, after all, a fund that is supposed to be for investors that are approaching retirement or at retirement, and that's supposed to give relatively predictable, safe returns. So you have to walk that fine line. It is possible for me to go out into the cash market and get up to 15% returns on an annual basis in certain types of credit, but while that might be appropriate to have 1 or 2% of those types of instruments in your fund. Having, say, a 10 or a 15% exposure to something that will give you 15 or 16% is not appropriate at this stage, or probably at any stage.
If you just look at your charts, at the chart now on your screen, you'll see how the fund is actually positioned at the end of January. You'll see that the majority of the fund, 46.8%, is actually in money market instruments, which has got a term to go below 3 months. And then you've got cash on call, which is 15.3% of the fund, fixed rate investments above 3 months, which is the red shaded area. And if you look at that maroon shaded area, 18.7% of the fund on floating rate notes that are in essence got maturities of more than 3 months. I mean, Albert, just quickly, are you happy with that as a positioning at the moment? Are you looking to change it?
Well, I'm not entirely happy with it at the moment. I'd like to get that cash on call as low as possible. We just had a couple of big inflows during January, so the cash there is a little bit more than I'd like. Firstly. Secondly, there hasn't been that many auctions in the markets in December and January, so obviously there hasn't been that many places where I can put the money. The money market space, especially in your high yielding instruments, are distinct from the equity markets where there's almost zero to very little trading going on. So I have to wait for companies to come to market. What that means is I need to wait for whether it's RCS, whether it's Equestra, whether it's one of the other corporate people that are looking for money. They need to come to the market, come to fund managers like myself and say, we're looking for 500 million rand. Are you willing to give us money?
Yeah.
Yes or no, and at what rates? And I'll be putting away some of that money over the next month or so. I'll also be going towards the banks and putting some money there. But no, not entirely happy with the 15% sitting on call. I like to make my money work for my investors.